You probably heard Elon Musk is buying Twitter for $44 billion. In this video, we're going to break down the bull and the bear case for this deal, talk about how Twitter is a substantially worse business than Facebook, the actual terms of this merger agreement, how it's going to work, and some interesting comps for the company. Stay with us.
I'm Hannah, this is Aaron, and you're watching the Piper Rundown. We analyze business and culture to help you win.
We want you to win.
We do want you to win. We're all winners here, especially our sponsor of today's rundown, Rivers Agile. Rivers Agile merges strategy with engineering to purposefully craft software solutions. Make sure you stick around until later in the video so you can hear precisely how they can help you straight from one of their employees.
Elon Musk has agreed to take Twitter private. He has signed a deal, an agreement to purchase Twitter for $44 billion at $54.20 a share. He managed to get $4.20 in there.
Wow, beautiful. I didn't even realize that until just now. That's beautiful.
$54.20. However, Twitter is currently trading, at the time of this recording, around $48 a share. So what we're going to do in this video is break down the nature of this deal, some of the details of Twitter itself, the company, talk about some of what the potential pathways look like, make some vague predictions, but candidly, this is such a crazy story, we don't really have a good feel for that, and we don't want to BS you, so we're going to just give you the honest truth, which is that there's still a lot of uncertainty.
There definitely is.
What we can tell from the fact that the stock is still trading at $48 a share tells you that there is a meaningful amount of uncertainty about the capacity for Musk to close this deal. What has been said is that this will be aiming to be closed by the end of the year, about 6 months, but that could potentially move on over into early 2023 if things really get stuck. Here are the steps of the process. This is going to be a merger, meaning there is going to be a new company created. That company is going to be filled with cash by Musk, by his financiers, by the debt that he's raising to make this LBO, leveraged buyout of Twitter. Once that company is filled with cash, that cash is going to be transferred to the existing shareholders on a per share basis of $54.20 for their shares in order for it to now be possessed by the company that it's merging with, and that new company after that transaction will own all the shares of Twitter.
Makes perfect sense.
As I said, it's supposed to be closing in the fall. Twitter is not allowed to go out and solicit other deals. So as a part of this arrangement, what can happen is a buyer can themselves come inbound and say, hey, $54.20 is too low. I'll give you $55. I'll give you $56. I'll give you $60 a share. And Twitter can hear that offer, but Musk will have the first right of refusal, meaning you will have 4 days to match that offer from any inbound. And if the offers are the same, they must sell to Musk. They cannot sell to the inbound offer. So part of this deal is about exclusivity. There's also terms about the potential termination of a deal or the termination of the deal for some other buyer. If that other buyer were to come in and they were to accept that other buyer's offer, a $1 billion fee would be paid to Musk.
Jesus Christ.
So typically in leveraged buyouts, there is about 30 to 40% of the acquisition funded in cash from the entity that is doing the acquiring. And then the rest, the reason it's called leveraged, is the rest is financed with debt. And the idea, part of the boom in the private equity industry generally, is we acquire this company on a proportional basis for not the entirety of its value. And then down the line, we sell it. And because it's growing as a percentage of the total cost and not the amount of cash that we had to outlay, we just paid the interest payments, we can make a proportionally larger return by making that acquisition. In this case, he has to put up considerably more cash for a couple reasons. Number one, it's just such a fantastically large deal. Number two, there's more risk in it, so they need more guarantees. If you're some private equity firm with, say, if you're a private equity fund with, say, a $3 billion fund, and you're acquiring a company for $300 million, they don't particularly need much more than whatever the minimum percentage is, because they know you have the cash to be called upon if something was really an issue and the company collapses and they need to come after you for that debt to be repaid. They know that you're probably good for it because of the size of your portfolio. In this case, Musk is one of the world's richest men, and yet they need a lot of guarantees to ensure that lending him as much as $25 billion will get repaid in some way, shape, or form.
That sounds reasonable to me.
Before we get into the numbers, we want to talk about why Elon is doing this. There are the kind of front headline reasons.
Sure.
Free speech.
Free speech for everyone.
Mismanagement. I would argue that this is primarily about free speech for Elon himself.
I would agree.
Tesla is notorious for not paying for advertising. They do pay a lot for PR, much more than most people realize. But a lot of their PR has also been garnered by his propensity to tweet, which has escalated over the last couple of years.
Certainly.
There is also some rumblings that the SEC already has fined him for tweets that he sent, but could try to actually muzzle him and limit his capacity to tweet about different business goings on. This I read as, whether it's shadow bans, whether it's blocks, whether it's cancellations, as we've seen with the previous president of the United States, is ensuring his means of distribution on the most important channel for communication that he possesses.
Yeah.
That's fundamentally, amongst, I think there's a multitude of other reasons, but I think that that is one of the primary reasons. Securing his capacity to communicate to the general public is one of the primary reasons behind this deal.
Do you see similarities in this? We've made a couple of YouTube shorts along the track of this story, but one of the first that we dropped was how comparing Elon and his interest in buying Twitter to other billionaires and their propensity to buy media companies eventually. Do you think that's the reasoning behind all of them? Do you see that management of their PR, of their messaging, heavily invested with all of them?
I'll go a step further, a step more extreme, and I'm not actually saying this is going to happen, but it clarifies the point.
Okay.
When there is a political revolution, when an authoritarian takes over a country, one of the first steps is to take control of the radio stations, the TV networks, the primary means by which people get their information. If you control the primary medium of communication, the newspapers, the magazines, the primary place that people get their information, you have an enormous capacity for propaganda.
Yep.
This is in a business sense. I'm not saying that he's going to overthrow any governments. I'm not even remotely close to arguing that. This is his ministry of propaganda. And he needs to have as powerful and relevant a platform to get his message out as possible. It's the reason that the billionaires want to have their different newspapers. They can go to war with their other competitors, elevate stories, elevate concerns to the general conversation. His platform for doing that is not a conventional media company. It is a social media company.
I see it as being like the most effective, though, out of any other thing. Like,
well, it's just a different scale. You know, Warren Buffett bought some newspapers. He bought a bunch of regional newspapers. Bezos bought one of the biggest, Washington Post. It's very, people are used to, billionaires owning TV networks or magazines like Benioff or newspapers. This is just a very digital, modern version of that.
Yeah. Very true. All right. Are we getting into some numbies for this deal?
We sure are. Not only is there $1 billion payout if Twitter takes another deal, if Musk cancels this deal, he owes Twitter $1 billion. So they're trying to lock him into getting this deal done. In the same spirit of using debt to finance a deal like this, what is very common in LBOs in private equity is the slashing of employee headcount. And the reason for that is they're trying to flip and resell the company and basically make it more attractive and more valuable, not only by increasing revenue, but by increasing the difference between revenue and expenses, showing that it has a higher capacity to be profitable. I would suggest that that's something that we can also expect with this Twitter deal for a slightly different reason. In 2021, Twitter did $630 million of free cash flow. Now, this deal includes, for the $44 billion acquisition, a $13.5 billion loan. For investment-grade loans, we could expect that to be at about a 4.5% interest rate. 4.5% interest on just $13.5 billion is about $600 million. So his capacity to fund his debt to acquire the business basically equal to their free cash flow from last year. At the same time, they have 7,500 full-time employees, approximately. They do about $650,000 worth of revenue per employee. That is $1 million less than Facebook. Facebook does $1.6 million of revenue per employee.
How many employees do they have?
More. Twitter did just over $5 billion in revenue in 2021, $3.72 billion in 2020, $3.4 billion in 2019. So while revenue is probably going to continue to grow, he needs to find a way to slash expenses to just ensure that not only is he going to have the cash to make those interest payments, but another important point here, the other $33.5 billion is coming in cash. Part of that cash that he's going to use to actually make the acquisition is a $12.5 billion margin loan against his Tesla equity. If you've watched a show like Succession or other movies like Margin Call, what happens is when you have a margin loan, that loan is conditional upon the equity that it is based against staying within a current range. So let's say hypothetically, you get a loan against the value of your house. Let's say it's a $500,000 house and someone loans you $300,000. If the property value of that house crashes to $100,000, the bank's no longer comfortable loaning you $300,000 because the thing that it's secured against isn't even worth that. So the same is true, just at a much larger scale, when this margin loan is secured against Tesla stock. Now, Tesla fell on the news of Musk making this acquisition, and if it continues to fall, his capacity to insure that $12.5 billion margin loan would be in question. So what he's going to want to do is to refinance his loan against Tesla equity by cutting headcount, showing a greater capacity to be profitable, and saying, hey, this doesn't have to be all tied to Tesla. You could tie it to this Twitter stock right here, or the value of Twitter as a company, because I have already made it more profitable just by cutting headcount.
Wow. Damn, it's so layered, so complicated, so layered.
The one reason that might be difficult is because Twitter's a publicly traded company, their employees are partially compensated with stock grants. Now that it is a private company, stock grants aren't worth the same, and so they may need to be paid more cash in order to stick around. There's also a number of employees that are saying they are going to leave because they don't want to work for Elon Musk. Although they work for Jack Dorsey, they work for these other billionaires that are involved. It's kind of silly. There will be challenges to improving that revenue per employee number. There will be challenges to keeping the expense of each employee down, but I think it is an absolute given that there will be considerable layoffs at Twitter if and when this deal gets closer to transpiring. And who knows, that could be potentially a start of a powerful new chapter for the company.
All right, let's move on to the comp section where we discuss comparable companies and deals and competitors in the space. This should be interesting.
We're not going to talk much about competitors. We can point to Snap, which has less free cash flow than Twitter. We can talk about Facebook, which has considerably more. That's not really the point here. The point is super rich people deciding to buy media properties and leverage buyouts at a enormous scale.
Sure.
On the rich people side, you got the Rockefellers. The Rockefellers studied intensively the power of radio to influence people, to be a means for dictating PR and overall branding. They were highly influential in the radio space, highly influential, the world's largest CPG companies in this realm of television. We've got Jeff Bezos, who owns one of the world's biggest newspapers, the Washington Post. This is what the richest people do. We've talked about that before. In the realm of leveraged buyouts, it's important to not understate how enormous of an LBO this is. Some of the other biggest ones were like in 2013 when Berkshire Hathaway and 3G, so Warren Buffett and his Brazilian buddies, took H.J. Heinz private at a $23 billion valuation. Now, that's $23 billion in 2013 dollars, but that's really about as big as it gets.
Wow.
There's a couple others that have been, in the 30s and the 40s that you wouldn't know because they're more, infrastructure, just not brand name type of entities. But that's really like one of the big ones that has like ever happened where a publicly traded entity was taken private. Michael Dell took Dell private at about a $21 billion valuation. Like those are the other ones that we've seen of a similar scale. And the Dell one worked out. That was a good deal. And by all accounts, it seems like Heinz has been a decent deal for Berkshire and 3G. But this is at a scale that is not quite to the unprecedented level. I hate when people use that term,
Sure.
but it's a pretty darn big one.
Yeah. Pretty darn big. All right. On to what I think is going to be my favorite portion of this video, the meme factor, where Aaron and I discuss the memeability of a company or a deal on a scale from 1 to 5. 1 being negative memes, 3 is completely neutral, and 5 is all the positive, dank memes. Here's the thing. I have seen equally as many 1s floating around on Twitter and other social platforms about this story as I have 5s. I think it's like people are either way for it or way against it, but it's Elon Musk. We have used him as like the example for all of our 5 meme factors, and there have never been more memes about a business story in recent memory. So I'm going 4.95.
Wow.
Yeah.
I'm going 4.5. I think that it's important to deeply skeptical of the notion that a bunch of people are going to quit using Twitter because of this. All the journalists and the blue checks and characters like that.
Right.
That's a farce. That's nonsense.
It is nonsense.
There is definitely, there's all these attempts at making like a right-wing version of different social platforms.
Sure.
I'm sure there's going to be some attempt at like a left one.
Sure.
I do not see that having any legs. I'd be shocked.
Mm-hmm.
And it's still the place that like people come to for news. They come to share articles. There's tons of traffic. There's tons of attention there. And a bunch of people saying that I'm canceling my New York Times or my Washington Post subscription. Like those are still both booming businesses.
Yeah. 4.5. I thought yours would be higher.
I think there's a little bit of the negative tailwinds. And I also think, this is getting into the bear case a little bit, I also think that like people kind of overestimate how good of a business Twitter is. They think it's so huge, there's so much attention. Mm-hmm. They kind of miss that it's like not a great business, which is a little bit of a headwind.
Well, way to tease the bull and the bear case. But before we get to that, let's hear from our sponsor, Rivers Agile, one final time.
Because you have all these different systems interconnected, bringing a new system in and then interconnecting that it's tough because you're working with multiple different companies. These packages, especially the new ones, may not interoperate cleanly with some of the other older systems, right? And so you've got to be able to bring those together and really harmonize the whole system.
All right, on to the bull and the bear case.
A decisive hard layoff can at times be bad for morale. Other times it can be clarifying. It can kind of cancel some of the side projects that were just a waste of time. It can remove some of the characters on the team that aren't maybe A players. Yep. It can have a, slimming effect, for lack of a better metaphor. I think that is where a lot of the hope would start from for the potential of Twitter to finally leave what many people in Silicon Valley have called an era of being a clown car that fell into a gold mine. That's an exact quote from Mark Zuckerberg.
Wow.
They caught lightning in a bottle with the format of Twitter. They really struggled to turn it into a great business. They have spent the last couple of years making an enormous investment into the infrastructure behind the scenes for Twitter, getting rid of a legacy of technical debt. So there should be some flexibility and ability to introduce even more new features and elements to the Twitter platform. I think that it is getting loads and loads of free PR in the form of this deal with Elon, as Elon is apt to do. And I also think that for as controversial as he is, the reintroduction of Donald Trump to the Twitter platform would also ensure that a lot of people were paying attention to the platform. A lot of people were spending their time there. I'm not predicting that would happen necessarily. We're at least half a year or more away from that. Sure. But I can guarantee if you wanted to grab some headlines, and in the same way that Donald Trump was great for the bottom line of CNN's business and their coverage of him, the reintroduction of Donald Trump to Twitter would be very good to the bottom line of Twitter's advertising revenue, in my opinion.
It's a mean bull case.
On the bear side, this is not a good business. This is a business that, as a share price, outside of some spectacular peaks in the craziness of the early 2021 public market, was largely flat from its IPO.
Yeah.
We don't talk about that when we talk about the other like big tech companies that you think of: Netflix, Amazon, Facebook, Google. They're all up stratospherically since their IPO. Not the case with Twitter. Really have struggled to develop a meaningful advertising product. Have only recently dipped their toe into paid subscriptions and newsletters and these other types of solutions. For all the attention, for all the cultural relevance, the utter lack of business execution is not something that one would think likely could turn around after a 16-year history of the company.
Yeah.
That would be saying the last 16 years have not been evidence of what the future will be.
Right. Oh, it's a pretty strong bear case. Damn. Well, that's the rundown. Thank you for watching and sticking around till the end. If you have, make sure you hit subscribe so you don't miss a single upcoming rundown. I'm sure we'll be talking about this again because Elon's always up to something. Thanks for watching.